All right, guys, it is October 9th, coming in the end of the week. Kind of a choppy, rough start for October. I'm actually going to just hit on the global macro stuff. I'm putting out a new piece on the CycleEdge report. This is going to be one of the first, I guess, editions to go out. I've been kind of working on it for a while. So anyway, I think I can actually embed the videos along with the written up charts, etc. So a little bit of I don't know, kind of the old way, which of the ways we used to do analysis, and then the videos are obviously helpful because I can kind of just show visually a little bit more than I can in text, and all the time and effort it takes to edit these sheets and so forth. But it's going to be good. I'm looking forward to it. So let's just get right into it. I want to start with the dollar, and we know we get the dollar right, we're going to get a lot of other markets right. And I think the biggest thing to me, you're going to see a similar theme across a lot of markets. So global macro, everything's connected, but we're still in a long-term bull market. So I get the reasons for being dollar bearish longer term, and I think people need to kind of clarify their time frames when they talk about their calls on the dollar, or any market for that matter. But when the longer term picture, is the dollar going to get trashed? Most likely. I mean, is that when we have a big change in the financial system, whether that's rates going negative in the US? I mean, there's a lot of things that can happen, but obviously what's going on with the deficits, the Fed, all the typical stuff that the dollar bears want to talk about, and they're valid points. But the way we view the trend and the longer term cycles is we've been in this long term bull market since 2014. And you can see on the monthly chart, we're actually bottoming out with another monthly cycle, which is very powerful. I mean, each time we've kind of broken down the daily and weekly charts, we've held major levels. So I've been using this uptrend line. The dollar index held exactly where it should have, in line with these higher lows. And then again, this monthly cycle matters. When I go to the weekly chart, you can see this the trend line again, but in addition to our pi line, this tripped a lot of traders up. A lot of dollar bears and euro bulls were getting all twisted up down here because we were below the 200 and a lot of traditional daily metrics that people use. But our pi line, I mean, it just trapped the bears once again and held exactly where it should have. Now, when we came into this year, you had price held pi initially. We had a nice move up, and then we had that crazy outside move. The euro was going nuts, and just a lot of confusion around March and April. So here we had the pullback, you made another higher low, and then we did break pi. So there was cause for concern, obviously, and this has been the intermediate term bearish part of the dollar that has really affected a lot of markets. There's a high correlation between equities, commodities, gold, oil, the softs, the grains, and even Bitcoin has a high correlation on a 30, 60, 90-day basis to the dollar. So what do we need to see from here? I'm going to switch to the euro. It's the 92 level on the dollar index I care about. This was the pivot that we put in 3 weeks ago up at 94.95. It was the underside of the March lows. The euro versus dollar, we talked about it. I'm just going to go to the daily. I mean, the weekly cycle is low, so we're trapped between a weekly and daily cycle. And when you look at the daily, we held the bands exactly here in front of 116 after a pretty good move from 120, which we talked about was kind of the top of the range. I do want to say that the monthly level failed exactly at pi. All right, so after basing, trying to break below 108, the move all the way up to 120, in the context, guys, of these multi-decade lower highs, that's a very strong candidate right here that we made another long-term lower high in the euro at 120. I know I get the dollar bear case, but you got to realize that a lot of that's the same things can be said for Europe, the Eurozone, Japan. So we don't want to get too much into the why the market should do something, but the ranges are clear. It was 120. We were in a 120 to 117. We broke the bottom of this range. The intermediate term, you got the pull back to the bands that held. So now we're in this world of 116. We got through kind of the 118 level. which was on the 4-hour. This was this pie line right here I'm watching. So we're getting above there to end the week, which tells me that it drew this regression channel. It's 2 standard deviations. You got room to push to 119. I think you're a 116 to 119 range is what I want to trade. If you get above the resistance here at 119, then obviously it's 120. But this is important because like I bought puts down here at 116 just to hedge some gold longs. And now that the dollar's kind of selling back off, if we're going to see 119 over here on gold, you can see that this is a pretty decent candle. Just putting in a series of higher lows again. There was some nervousness when we broke 1880. I didn't disagree with being cautious just because a lot of times when you break the bands, you get the deeper pullback. So we were thinking maybe 1750 would be in the cards down here around the 200. But again, the euro bounced, dollar fell off. So gold's doing fine again. So we're going to watch 119 in the next week, and then that should correlate with this 1950 area, which is the downtrend line that's going to come into play. You can also draw the underside of the wedge that broke. So this whole 1950 area matters. I have a few calls up there. I did short silver this week, which I'm out of the money on. It was just a one lot with some puts, so it wasn't a big position. But offsides on that, and then I'm only small long gold. So I'm looking to add to this. I just kind of want to see what if we're just going to chop around, or are we going to chop 1850, 1950, or are we going to chop 1850, 2000? Are we going to chop euro 116, 119, euro 116, 120? That's probably the world we're in through November, through the election, and then maybe we get a little bit more of a trending market with some follow through. So anyway, that's what I care about the dollar. That's what I care about gold. I guess on the lines of the dollar, then you're going to have the oil market. I touched on this in the CycleEdge report. I thought it looked really bearish coming into this week. You had the big move down to start in August, which actually oil started to break before equities had their rough September. Then you had a little reflationary bounce, which is fine. You're oversold. You retrace the bulk of this move down. Okay, you make a lower high. And then by the time we started to break back through 38.37, I mean, that just couldn't have looked more bearish. And I know a lot of other app traders that was kind of an obvious nasty looking chart. And then the fact that we just had the reflationary bounce this week all the way back, and this is what I mean, it's just a choppy market. So I still think oil is I'm more bearish, but again, we're going to need the dollar to kind of cooperate. You're going to need a stronger dollar to get, I think, oil to break back below these mid-30s. So to me, again, yes, we're making lower highs. Yes, you're kind of having these lower highs on the RSI. There's a lot of things that say oil is getting heavier. But again, are we just going to chop 36.42? That might be the case. Equities, tough start to October. Had a really good September. Already gave it back a bunch just because I pressed the shorts a little bit here, especially on the small caps. We broke to a new low. We covered really well. We came back up. I started shorting here in 1520. I added here at 1570. We put the topping tail in with the Trump COVID news. I added to it, and then we just put a topping tail takeout, ran the stops. I had to cut risk. And that's okay. That's the way it goes sometimes. I still think, yeah, maybe we test 1700. Maybe not. I mean, this is still the right area to be short from. We got good squeezes in January before we rolled over. You had a good squeeze in June before we had a decent sell-off. But you got to risk manage this stuff. It wasn't a clear break. That was the right level that needed to hold. You know, it's probably trapped in a lot of bears, and then now you're getting the squeeze. So you need to have other stuff on the other side. The tough part about October has been like, I was bullish coming into the lows on like Amazon. We went long. We called the low down here. We had a really good trade. But since we rallied all the way back to 3,200, I've trimmed my position so much that I wasn't as long as I wanted to be with this rally, and especially the small caps doing what they're doing. Amazon hardly even rallied. The NASDAQ today, for the first time, I talked about it, this 50% retrace kind of, let me just draw the wall. Trying to go as quick as I can so this video is not too long. This was the move down 50%, about halfway. This is kind of where we were struggling to get above. And then Friday coming into next week, I mean, we cleared that high. So I'm a little bit long. I'd like to buy a better dip, whether it's like an hourly or 30-minute dip. I'll most likely be playing the long side and intraday J trades as well as the NASDAQ, but it looks like maybe there's room to go back to the highs. I mean, tech is a great place to be. There's only so many companies that can put up the kind of margins and earnings and revenue that some of these companies do. It's a big difference than owning like financials. Big difference in owning things in the energy patch, which have been absolutely horrible. So still overall bullish the NASDAQ. That's a good place to be long. I like that Paris trade. It just was a crazy week, and small caps just tough week to be short small caps. Lastly, what did I touch on? Bond market. Oh, let me go back to the VIX. So I thought the VIX was crazy for hanging in here above 30 when we were getting pretty decent rally in S&Ps. And again, that kind of started to show up the same kind of way in last several months. So I don't know if it has to do with the crazy gamma positioning, and there's a lot of front running, maybe volatility, people thinking around the election that just kept the VIX bid. But I mean, we've had a really good rally in S&P, and it wasn't until today and yesterday that the front month VIX finally broke down. So that was good to see. But again, I wish I would have been more short. I mean, I covered 29.5, came in this morning, it was down to 27. Not much to do there. I don't want to get long VIX since I'm short the Russell the amount that I am. I don't. You need these spikes like this to short. So go back to the short side on vol, and then the right spike will signal that. UVXY got smoked. That would have been a great short if you would have been putting puts out and selling calls on this last spike around pi. I mean, that's just, there's 10 points for 28 and 17. It's another great trade. We know we like that strategy. Talk about treasuries. Treasuries were very quiet with almost no volatility. It's really hard. This is a really tough place to make money when you've got the 10-year at 50 basis points, rates at pretty close to zero, and nothing even moving. So you can't get any income from holding bonds because the yield's pathetic. And then if you don't get any back and forth, there's just not much opportunity. So it's kind of a sad thing to see. And it's pushing people out the curve. So the only movement I'm getting is trading 30s and ultras. And unfortunately, we've had some really good calls on ultras. I just came into this week not having any on and regretted it. So it is what it is. I like being long 10s and 5s, and then you can short 30s and ultras against it type of thing. We had some levels to cover this week. I did finally just short ultras just to hedge the book. We'll see whether or not we get the bigger move back to these lows. Down below 213, people are going to use this 200. We'll see. I'm kind of long enough 10s and even 30s in a couple of accounts that kind of want to see a rally because I'm out of the money on those positions, and then I can maybe feed ultras another little bit higher. So that's how we're trading bonds. I talked about it in the report as well. Touched on gold, oil. I think that's it, guys. I would go to, if you're new to us or you want to know how to sign up for the CycleEdge, I want to talk to you about the pricing on it. Go to jenkinscm.com, Jenkins Capital Management, jenkinscm.com. If you click here, CycleEdge 2.0. This is where we're talking Forex, equities, bonds, all the good stuff that we trade, and individual equity names from time to time. But guys, this is this deal, $250 for the entire year. You probably get a week before I'm going to go back to $150 a month, just because I'm putting out the same global macro high level stuff as any quality trader that you might have over, like any of the prop guys or guys that have trading services. They're all $150, $100 a month. And they're not really putting out a lot of signals intraday. It's more of like, hey, give you a morning update with some charts, what to look for, levels, blah, blah, blah. So this is This is a lot of cycle work. It's a lot of trade signals. It's $1,800 annually, and then the other choice is going to be $500 semi-annual. So you save $800 doing the semi-annual. But you guys still, I mean, that's $1,000 for the year. So it's $250. I can't offer this any better. I want to get people the right edges they need when this market's flying around and coming into an election and everything that we've got going on in 2020. So hope that helps. Guys, have a great weekend. I'll probably have an update on crypto also. And we're rolling out the CycleEdge crypto membership as well. So look for that. And also I have an options offer I'll be coming out with this weekend. I want to trade more of the biotech, all the stuff that's coming with the therapeutics. I mean, Trump's forcing, just some of these names that we looked at. There's so much more to do, guys, on the options basis around biotech, the therapeutics, all the vaccine trade. So instead of just deciding whether or not you want to do options to trade gold and bonds, I'm still going to have what's available. On the option side is you get with the options course, guys, and the option edge team, you get the entire model and process that you can learn. So if you want to learn something that you can have the rest of your life, how to view the markets, the trend, the analysis, how we work around the cycles, how we talk about it in a fractal manner, meaning multiple durations, near term, intermediate term, long term, how to work positions, how to scale in, scale out. It's a 9-hour course. It's everything that I've built and brought to the institutional desk when I was running the rates desk. And you get all that in the options team. Plus, I talk about the option strategies we like, the ratio callback spreads, that volatility index, the UVXY, what I was talking about. There's a vol strategy in there we do a lot with. So you can apply that to everything that we've been doing. Global macro, which is where we spend most of our time, but you can start applying this to smaller names where, we're going to get these crazy biotech moves. You can catch some of this stuff that's a 5-bagger, 10-bagger. So look for this weekend. I'm going to put out a special offer for that. That's going to be all of this included, $6,000 value, but I'm going to have an even better discount. And then I'm going to talk about what we're going to do on the biotech space, specifically focused on that. And so that'll be a different group, and I'll have the pricing on that. All right, guys, look for that this weekend. Have a great rest of your trading day. We'll see some of you Sunday night and Monday morning.